Federal Reserve just had some incredible things to say, and here's what you need to know about what happened. First, something of course the media is not covering. Jerome Powell said this very powerful statement. Listen very closely to this, and then we'll get into some of the other very important things that Jerome Powell said. He said, quote, Alan Greenspan, who was the Fed chairperson back in the 80s after Volcker, quote, famously said that pervasive uncertainty was the defining characteristic of the policy landscape. Now, it's worth remembering that Alan Greenspan made those comments during what we now think of as the Great Moderation. That statement has never been more apt than it is today. That right there is the most powerful quote of Jerome Powell quoting Alan Greenspan, or really of any of the quotes that Jerome Powell has given us ever. Because this right here just revealed what Jerome Powell truly believes about inflation. Now, to understand this, you have to remember what the Great Moderation is. The Great Moderation is the last 40 years of disinflationary pressures that we have seen, that have actually led us to run inflation for the last decade before COVID under 2% at around 1.75%, to the point where the Federal Reserve was actively considering reducing the inflation target they had to 1.75%, because the idea of the Phillips curve, which suggests that when unemployment is low, you are going to create inflationary pressures, was a very accurate tool for determining inflation, yet that ended up being very false. In fact, in today's discussion, Jerome Powell actually brought up the Phillips curve and said, maybe we've kind of been looking at the wrong thing. Instead of looking at the Phillips curve, we need to look at other aspects of unemployment to determine how much inflation we're going to have. So for a moment, if you're confused on Phillips curve, ignore it. If you want the quick takeaway, just know that Phillips curve argues that the lower unemployment is, the higher inflation should be, that there should be sort of a wall there. But ignore that for a moment, because Jerome Powell actually gives us a new tool. It's one he's talked about before, but he puts it in a new context. He suggests that, look, there's a difference between 4% unemployment and 4% unemployment. And this is actually a really powerful argument. It's the second most powerful argument that Jerome Powell makes. The first, that he's hinting that we might actually be at the next start of a great disinflationary moderation driven by technology and smoother supply chains. That's long-term very bullish. Don't get me wrong. I'm not suggesting there aren't reasons to be short-term bearish, whether it's the debt ceiling or whatever other drama, clickbait you want to listen to that doesn't actually give you a dose of reality. Because remember, there are two forms of negativity. There's that negativity that's like, oh my gosh, somebody's saying the stock market's going to crash. Here's why we don't think it's going to crash, because of here are the actual facts in the economy. And then there's the other form of negativity, which is just purely negative and doesn't seem to want to recognize reality. But anyway, so Jerome Powell told us there's 4% unemployment and then there's 4% unemployment. And what's the difference? Quits and vacancies. See, when people are willing to quit a lot because there are more vacancies, there's a sign that employees, labor, believes they have pricing power, and that leads to potentially an unanchored wage price spiral, which is exactly what Ben Bernanke today said was part of the contribution to the failure of what happened in the 1970s, and why the 1970s were so vastly different from the way, well, things are today. And that's pretty critically important, because most people, as Jerome Powell put it today, have not actually experienced inflation in their lifetimes before. Now, that's a pretty powerful argument as well, because it really begs the question of, okay, well, if most people haven't experienced inflation before, is it entirely possible then that people's expectations are wrong? Because right now it seems like people have this feeling that, oh no, inflation's going to stick around. How are you going to put the genie back in the bottle? And I kid you not, every single time I make a video talking about inflation, there are people in the comments who say, I don't know, man, when I go to the grocery store, prices are still high. My gosh, I really hope that by now you have watched enough of this channel to learn that is not how inflation works. Now, I want to keep talking about the new stuff, about what the Federal Reserve actually cares about and what's actually going on. But let me just pause for a moment for, unfortunately, dare I say, the people who haven't been educated by our school system and finance. Oh, wait, that's everybody. The people who haven't been enlightened yet. Let me just quickly make the argument. And I'm going to make this very simple. The Federal Reserve does not care how high your prices have gone. It's depressing because, yes, insurance is more expensive. The cost of employment, whether that's for a nanny or daycare, is all up. Vacations are up. Flights are up. Everything is up. But guess what? That doesn't make any lick of a difference to the Federal Reserve's desire to control inflation going forward. And that is very different from prices of the past. So, when we understand this, we can understand that in the 1970s, we had massively different thinking. Paul Krugman from the New York Times actually put together an amazing piece on exactly this. Look at this chart with me for a moment. In the early 70s, economists thought that price controls could slow inflation down. Price controls are a way of saying, oh no, companies are price gouging. Let's just put a ceiling on how much they're allowed to charge, on how much they're allowed to charge for gas, and that'll stop inflation. No, that fails because you create massive shortages. People have to pay with their time. Then the price controls become so politically unpopular that you remove the price controls, and then you have even higher inflation than if you just let the free market frickin' function. But then you see here in the 70s and 80s, we thought that you needed to raise unemployment to fight inflation. That's actually a critical statement here because if you feel like you have to raise unemployment to reduce inflation, you will force a dirty recession much like Paul Volcker did. But then we thought a good inflation target was 4%. But the reality is 2% was a better inflation target. This yellow line is inflation. The blue line is unemployment. This, by the way, from about Mr. Greenspan's takeover all the way the last 40 years over here to about 2017, well, I mean, realistically to about 2020, all of this is deemed to be about the great moderation, this slow decline in inflation, no matter what unemployment has done. And we've realized, and this is more for maybe the mathematicians, we've realized that what actually causes inflation isn't printing money or high prices. Those don't cause inflation. It is the rapid expansion of how fast you are printing money. So it is the rate of acceleration. Well, that is, acceleration is a rate. It is your acceleration of money printing that causes inflation. All right, let me try to just make that a little image, okay? If I print money like this, okay, I'm printing money, everything's good, no inflation. But if all of a sudden from 2020 to March of 2020, you all of a sudden go like, and you start spinning the wheel a lot faster, that is when you get inflation. And then when you're like, okay, now I'm gonna slowly turn it back, the theory going forward is that that should cause disinflation, which I wanna be very clear. That doesn't mean prices for your stuff are going to go down. It means prices stay at the high levels where they are, and they actually go up. They just go up at a slower level, or a slower rate than previously. Now, Paul Krugman is not maybe the best example of somebody because a lot of people don't like him when it comes to talking about the Federal Reserve. He's an economist. But Ben Bernanke puts it very well. And he says, look, we had massive issues in the 70s. We didn't control inflation expectations. And today, the bond market's expectations of inflation are extremely low. The problem is, you have a little bit of a disconnect between the bond market's expectation of inflation, which is a studied financial point of view on inflation, and consumers' expectations of inflation, because, again, quote, many are experiencing high inflation for the first time in their lives. And people are fearful about high prices. And that makes it very difficult to control a consumer's expectations of inflation because people don't understand inflation. That's why I have to continue to explain some of these basic concepts I feel like over and over again, because I regularly get, but Kevin. And those are your bears. A lot of them. Those are the people that are sitting on the sidelines in cash like, I don't know, man. I'm not convinced. There's going to be another leg down. There's going to be a double dip. Whatever. Like, do whatever you want with your money. But listen to what Jerome Powell said. Remember, I don't really care what you do with your money. I just want you to succeed. And so I want you to have the best information possible. And in my opinion, the best information possible is that Jerome Powell just implied we could be at the start of the next great moderation. Let me read you that again, and then I want to get to some other really critical things that he said, especially about restrictive policy rates, and a pause. Okay, ready? So once again, pervasive uncertainty was the defining characteristic of the policy landscape of the Alan Greenspan era. It's worth remembering that that comment was made during a period of what we now think of as the Great Moderation. And what do we have today? Pervasive uncertainty. We have no idea what's coming next. Well, we have some good ideas, but things could end up wrong. And the Fed has been wrong before. I mean, even just this chart that I showed you shows the Fed just doesn't have the best track record. So it's not like I want to be a shill for the Federal Reserve here and saying, oh, they were wrong all these times. They were wrong about price controls. They were wrong about unemployment. They were wrong about 4%. They were wrong about all the money printing that happened over here. They were wrong about 4% unemployment or below 4% unemployment causing inflation, and it didn't. And so they've been wrong in the past. And it's okay to say that. The point is, they're taking all of those lessons of the past and they're doing their best at least not to repeat these mistakes. And so at least by not repeating these mistakes, what do we know? We're not going to get price controls. We're probably not going to get a Paul Volcker, and that's why the stock market is rising again. We probably don't need to care that the unemployment rate is below 4%. In fact, Jerome Powell gave us the formula. He said, look, and I didn't finish this point for a reason, because now it makes more sense. Remember how I told you Jerome Powell said there's a difference between 4% unemployment and 4% unemployment? That's because 4% unemployment in 2018 was matched with a JOLTS reading that was 1-to-1. In other words, you had just as many unemployed people as you had job openings, so people had less pricing power. In 2021, there were 2 times as many job openings as there were unemployed people, meaning labor had pricing power, leading to potentially fears of a wage price spiral. That is bad, unsustainable, and that leads services inflation to keep running robustly. That, however, is starting to shrink. The JOLTS measure of inflation is starting to shrink. You're starting to see companies actually worried about their ability to raise prices at all anymore, whether it's consumer staples, your Targets, your Walmart, your Foot Locker. These companies are starting to panic. They're realizing they can't raise prices anymore as they were. Now, if you're part of our course member live streams, you already know this because it's not just me trying to tell it to you every day. We just look at the data and the facts. We look at the earnings calls every day and we do fundamental analysis every single day. And I teach you how to do fundamental analysis on companies where we're like, oh, damn, Palantir's balance sheet is really robust. Right the day before earnings. What happens? Skyrockets after that. Oh wow, Open Door's really oversold. This could be a really good temporary trade because the fundamentals are phenomenal and they just burned their bondholders, which is good for shareholders, but nobody read the 8K except I did. And so what happened? Open Door skyrocketed. What about Bill.com? Well, the fundamentals, and even as a SaaS business, price to sales ratios are looking really good here. What happened? Skyrockets on earnings. It's not perfect all the time. I'm just saying some of the fundamental analysis is actually really functional. You want to pay attention to it, so if you don't know about it yet, link down below. But what else did we learn from Jay Powell and Ben Bernanke? Well, first, Jerome Powell actually said this time that interest rates are restrictive. In his last press conference at the FOMC meeting afterwards here in May, he said, we think we might be at a sufficiently restrictive level of interest rates. Today, he said we are. And this led the futures monitor for interest rate hikes by the Federal Reserve to dump from a 36% chance of a 25 basis point hike all the way down to a 13.8% chance. Now, while it's very difficult to forecast what future shocks could really screw up inflation, Jerome Powell gave us a beautiful outline. He said, consider the following. Positive supply shocks exist just like negative supply shocks. The pandemic showed us how broken our supply chains could become very quickly with a massive increase in demand. That was a negative supply shock that followed massive money printing. But we don't expect that to repeat because we're not going to print money at that rate again. Hopefully. And at the same time, positive supply shocks exist, like technology, which, wow, reiterates the whole argument that we might see the start of a new great moderation, potentially even driven by AI. Which is also why I'm releasing a course on June 1st that's actually part of an existing course, so existing members are getting that totally for free, on how to actually use artificial intelligence as a productive human rather than just, oh my God, there are all these AI tools, that's so cool, how do we actually apply this to work? Well, I don't know. Like, I will teach you. Anyway, from a business point of view. Anyway, and if I could do it, you could do it, which is great. You just need guidance on it. Anyway, another thing is Jerome Powell told us that there are real one-time shocks that we had, not only that pandemic money printing, but also we don't expect another new invasion of a massive country into another country, Russia into Ukraine, right? And on top of that, you consider the increase of the global labor supply that has normalized, technology that obviously is a contributor to disinflation. We're potentially in an, dare I say, okay path to see another great moderation cycle over the next 10 years. Now, you might be frustrated, and rightfully so, over the inflation that we've seen, but consider the distortions that the pandemic created. Look at this chart here. This is, again, the Paul Krugman piece. Really, actually good piece this morning in the New York Times. I try to read all sources, Wall Street Journal, Fox, CNN, New York Times, Financial Times, Barron's, Bloomberg. I read everything just so I can understand every perspective. But this really shows you the dark line of what actually happened. This is what we thought would happen in the labor market, a slow decline of labor force participation. We have this, V shape over here. Same thing over here with GDP. Oh, Paul Krugman made a great point on GDP. He says, look, we could think GDP is one thing, but then it ends up getting revised. Like, we have a real issue with the data that we get, and that creates a lot of uncertainty. And he joked that, hey, like, if GDP or inflation numbers get revised, can we revise what we did with rates? Obviously, the answer to that is no. But they're saying this because they're cognizant that there are two-sided risks here. You could over-tighten, you could under-tighten. Except Jerome Powell made it clear we have the luxury now of time, that we've probably tightened enough, which again reiterates this 0 BP hike. Now, of course, the whole debt ceiling negotiation tanked the market a little bit, but that's beside the point. But anyway, some of these charts are really interesting in this talk about, potentially a soft landing or, wages, and comparing to the 1970s of how wage dynamics are so different today. Now, of course, the four most dangerous words in investing are this time is different, but you have to study history, otherwise you're doomed to repeat it. And at least in my opinion, I think the Federal Reserve is going to do everything in their power to just not make those mistakes. We could end up having the same result, which would be a terrible Paul Volckering, crash, but it doesn't seem to be the case right now, especially since Jerome Powell also made it clear that in times of high uncertainty, you can't actually provide as much of a forecast as you'd like because you actually remove optionality from the Fed. Because this is really him saying, if we start talking about how we're going to cut rates at the end of the year, we take away our options of actually fighting inflation, and people are all just going to go YOLO into the stock market and spending money again, and then we're going to create inflation again. So he basically said that in so many words by saying, yeah, if we're too clear about forward guidance, we end up limiting our options and we risk creating problems and being misinterpreted. He actually said that the best time for clear forward guidance is when there's little uncertainty, when you're at an effective lower bound like 0% rates, and you're just trying to suggest that that lower rate bound, the 0% rate, is going to continue for some time in the future. That's a way of basically squeezing a sponge and getting more stimulus out of the market without actually reducing rates anymore. But during times of uncertainty like those in which we're now, it's actually not necessary to provide as clear of guidance because you could potentially hurt yourself more. Now, regarding the debt ceiling thing really quickly, there's this talk about Republicans walking out and each side, the White House and Republicans, calling the other stubborn. There was supposed to be a framework for a deal this weekend. I think this is all political, posturing. This is all bogus. I really think this whole debt ceiling drama is going to pass. And at the same time, when we get that pause next month, assuming we don't get a reactivation of inflation, if we get a debt ceiling that passes and a pause, I don't know what you're waiting for to get back into the stock market. That is my personal bias. I want to be clear about that. But I mean, please, I'm asking bears daily to provide me data and facts that shows that inflation is still a problem, and they got nothing. Nothing. Show me another company outside of maybe aerospace that's actually showing massive price increases still coming this year. It's not there. Aerospace still has supply chain issues. That's still a pandemic lingerer. Of course, you've got rapid demand in services for, travel and hotel and labor, but that's already starting to soften. And we know that in reading the earnings calls of companies that actually hire people. Anyway, thanks so much for watching. I wish you the best. Good luck out there. I really want everybody to succeed, and I will continue doing my best for you. Thank you so much. Goodbye. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced